There's no doubt about it. The financial crisis was about financial institutions, and IFRS 9 was the ISB's response to it, which means that IFRS 9 is really about trying to solve perceived issues in the accounting by financial institutions. That doesn't mean the rest of us won't be affected, though. So, what were the issues? Well, there were two key ones that the board was really trying to resolve. The first was that, broadly speaking, people felt the existing accounting requirements were way too complicated. In other words, financial instruments accounting by financial institutions had become a black box that only insiders could understand. The second was that people were surprised by the huge impairment losses on loans that banks and others reported during the financial crisis, which led to major government bailouts. Naturally, the question was why the losses hadn't been reported earlier on. Of course, the response was that our existing model, what we call an incurred loss model, only reports losses once they've actually been incurred. It doesn't look into the future and try to anticipate things that might happen. Well, it didn't take long before people suggested that we do just that. Change the model so that it does anticipate future losses, not just those that have already been incurred. In other words, when the board drafted IFRS 9, it was really trying to do two things. One, to simplify the requirements, and two, to get bigger losses on the books earlier on. That's important context to keep in mind because in some cases you're going to be left shaking your head thinking, do they really want me to do that? And the answer lies in having this context to the problem they were trying to resolve. What's it all mean if you're not a financial institution? The truth is, it's hard to say. Though, many are going to end up with more volatility in their income statement. One of the main reasons is that there's been a shift in bias under IFRS 9. Whereas historically, when we didn't know where to put things, they'd end up at fair value through other comprehensive income, or available for sale as we called it. Now under IFRS 9, fair value through P&L has become the residual category. Basically, you're at fair value through P&L until you can demonstrate or designate otherwise. In a lot of cases, there might be little or no change in terms of actual measurement differences, but the way you get there could be substantially different. Whatever the case might be for your specific circumstances, it's worth looking ahead now before transition on January 1, 2018 so that you're not caught off guard with any nasty surprises and no time to remedy them. To help, in the next 20 minutes or so, we'll review the major changes that IFRS 9 introduces for classification and measurement and impairment to give you an initial feeling of what the more significant issues are. While the rules for hedge accounting have also changed, they only apply to those who choose to apply them. And so we've not included them in this series. Of course, if you're interested, we do have a number of publications and videos that are available on our website online. For the areas that we're covering in this series, we've also developed a publication, Understanding the Basics, which lays out the key elements of the standard and gives examples of how they'd apply to non-financial institutions. We tried to write it in contained bits and pieces so that no one has to read the whole thing. You can just focus on the parts that are relevant to you. As we progress through the videos, we'll include references to Understanding the Basics so that you can easily know where to learn more. Each video will introduce a key concept, and they've been designed with the intention that they could be followed by a discussion of whether and how that particular concept applies in your circumstances. As we talk through the issues, I know what some of you might be thinking. Yeah, Chris, this is nice and all, but how material could this be and how much do I really care? It's a fair question. For example, you might have short-term receivables that you set up at the amount due rather than discounting them under IAS 39 on the basis that the difference wasn't material. So your question might be, why you can't continue to do that under IFRS 9? The answer is, of course, you might be able to. Materiality continues to apply. So as we talk through these issues, you might want to think about how you can quickly assess how significant the impact of each could be in your specific circumstances. That's it for our introduction. If you've got any questions about this video series, our publications, or any other issues relating to your journey to IFRS 9, please don't hesitate to contact me, your local PwC partner, or any of our IFRS 9 specialists, and as always, we'd be happy to help.